Hi, I'm Anjali Kukreja. I'm a chartered accountant. I'm presenting a very tax news update on a topic which is amendments to India-Mauritius tax treaty. So I will just start with a very brief background. As we've seen, in the recent times, India has been very intensely involved in the BIPS projects. The BIPS action plans reiterate that the tax treaties are intended to avoid double taxation, and tax treaties cannot be viewed as instruments for achieving double non-taxation. That is, an income ends not being taxed either in the source country nor in the country of residence. Specifically, the BIPS Action Plan 6 Treaty Abuse recommends that the countries should make a very strong, clear statement that the minimum standard for entering into a tax treaty is that the treaty is intended to prevent tax avoidance, especially treaty shopping. In 1982, when India and Mauritius had entered into the tax treaty, the focus was to encourage FDI. However, in the last 3.5 decades, this has changed. Now the focus is to curb black money, money laundering, round tripping, and to prevent tax avoidance. In the light of the changed scenario, the Indian government had been renegotiating the tax treaty terms with the Mauritian government. Finally, a protocol amending the India-Mauritius tax treaty was entered on 10th August 2016. 8 articles of the India-Mauritius tax treaty were amended or inserted, being namely, first, service fee clause was inserted in the Article 5. Secondly, Article 12A, FTS concept was introduced in the India-Mauritius tax treaty. Article 11, interest article was amended. Article 13, capital gains was amended. Article 27A, limitation of benefits clause was added. Article 22, other income was amended. Article 26, exchange of information was vigorously reworded, and Article 26A, collection of taxes. Amongst these, except for Article 26, all the 7 articles, the amendments made therein are effective from financial year 2017 and 18. And only Article 26, exchange of information, which is only vigorously reworded, and the rewording is clarificatory, is retrospectively effective from July 2016. So we will go one by one for the amendments which have taken place. First of all, PE clause, Article 5. The second paragraph of the Article 5 reads as the term PE includes the clause J, furnishing of services including consultancy services by an enterprise through its employees or other personnel engaged for such purpose, where the nature of such activities continues for a period or periods aggregating more than 90 days within any 12-month period. What is interesting here is that the language states furnishing of services including consultancy services, whereas in most of the other TDAs that India has, the language is furnishing of services other than the services included in Article 12. We will just analyze what is the difference in the implication. When we use the term furnishing of services other than the services under Article 12, FTS, what we are trying to say is that if any services are attracted by the service fee clause and they do not meet the service fee threshold, then it will not be taxable in the source country, as it would become business income not effectively connected to a PE and hence not taxable. And similarly, if a service by its nature qualifies to fall under the FTS clause, then even if it is rendered beyond the service PE threshold as mentioned in that tax treaty, it will still be treated as FTS only. The drafting in this particular language, furnishing of services other than the services covered under Article 12 FTS, says that the focus is on the nature of the services. The taxability depends upon the nature of the services which is being rendered. However, the drafting which is there in the India-Mauritius tax treaty, which says furnishing of services including consultancy services, the focus is on revenue. See, what does it imply? It implies that if the consultancy services are rendered for a period of more than 90 days in the source country, then it would be taxable as business income effectively connected to a PE. Say the source country is India, it would be taxable at full rate of 40% plus for charge and cess. And if such nature of services, the consultancy services, continues for a period of less than 90 days, then it would be taxable at the rate of 10% on gross basis under Article 12A. So it's like चिट भी मेरी पट भी मेरी, टैक्स तो देना ही पड़ेगा, 10% पे दो या 40% पे दो, टैक्स तो देना पड़ेगा. So I think the omission of the term furnishing of services, omission of the term other than the Article 12 FTS is very conscious, deliberate, very aggressively favoring the revenue, and it's very clever also. So after appreciating Article 5, we can move on and appreciate Article 12A FTS clause. Earlier there was no such FTS clause in the India-Mauritius tax treaty, so if there was any business business income which was not effectively connected to a PE, it will not get taxable in India. Now, as the FTS clause has been inserted, so any services which are of the nature of technical, managerial, or consultancy or such nature of services, they would be taxable in the source country at the rate of 10% on gross basis. So, more income has been brought to tax in the source country. So, it's very, all the provisions are very clearly added. Then we would continue and move on to Article 11, interest. In the Article 11 interest, earlier interest which was arising in the source country could be taxed at full rates as per the domestic tax laws of the source country. For example, any interest arising in India could be taxable at the rate of 40% plus surcharge and cess if it was paid to a Mauritius resident. However, now they have done a limitation. They have said that any interest which is arising in India, being the source country, would be taxable at the rate of 7.5% on gross basis. So the source country could tax the interest on at the rate of 7.5% on gross basis. So they have slashed down the rate of tax on the interest from 40% to 7.5%, giving an impetus to debt structuring from Mauritius to India. Similarly, in this article of interest, there was another clause which said that if the Mauritian banks were deriving interest income from any debt claims in India, then that was fully exempt. However, now they have made it fully taxable. From 1/4/2017, that is, it is written that any debt claims which are existing on 31st March 2017 would continue to be grandfathered. That is, any interest that the Mauritian bank derives from a debt claim which was made on or before 31st March 2017 would continue to be tax exempt. Now we move on to another amendment, which is Article 13, capital gains. As we know earlier, any capital gains arising on sale of shares of, say, an Indian company, it would be taxable as per the residence rule. That is, it would be taxable in the state of the residence of the taxpayer. So, for example, a Mauritian company was to derive capital gains on sale of shares of an Indian company. It would not be taxable in India, but it would be taxable in Mauritius. And there are no such taxes in Mauritius, and it is not taxable in India also. So it was there was no tax on such income. So just to bring in, just to prevent tax avoidance, what they've done is they've realigned this to the source rule. Now, any capital gains arising on sale of shares which were acquired on or after 1st April 2017 and sold after 31st March 2019 would be taxable at full domestic tax rates. So, and they have also given a 50% tax exemption for any shares acquired on or after 1st April 2017 where the capital gain arises before 31st March 2019, then such capital gains would be taxable at 50% of the prevalent domestic tax rates. Now, when I read this, I thought I will just break this down and slowly read it again to understand what is the benefit which is being offered. So what they are saying is that if you have acquired shares on or after 1/4/2017 and capital gain arises on the sale of such shares before 31st March 2019, then you will be taxable at 50% tax rate. So we can just broadly analyze: shares can be listed shares and shares can be unlisted shares. So for listed shares, if they are held for more than 12 months, sold through a recognized stock exchange, STT paid, then it is anyways exempt, so no benefit achieved. So for listed shares which are kept for less than 12 months, the tax rate as per the domestic tax laws is 15% under section 111A. So this 15% would be slashed to 7.5%. Similarly, for unlisted shares, the period of the holding to qualify as long term will be 24 months or more, but the capital gain should arise within this 24 months. So it can never be long term. So for any unlisted shares which was acquired before 1st April 2017 and sold within 24 months for any period less than 24 months, that is before 31st March 2019, the short-term capital gain is usually taxable at the rate of 40%, being the full maximum marginal rate applicable to the particular assessee, say 40%. Then this particular tax rate is slashed to 20%. Now, and there is also a limitation of benefit clause which states that if your entire transaction is designed to take advantage of this clause, then you will not be entitled to the advantage of this clause. So I thought definitely there must be some very good benefit that this particular clause must have given. So I thought, let me just analyze. So if I, from a Mauritian investor point of view, if I was to invest into listed shares and then to keep it for less than 12 months, that is, there is likely not to be too much of a capital appreciation or dividends in both the cases. If I was to invest in either listed or unlisted shares and I was to keep it for less than 12 months or 24 months, there was not too much of a capital appreciation or dividends that I would be getting. Only for this 50% tax exemption, will this actually look like a very competitive investment option? So I was not very convinced about the benefit, and I thought only in a scenario if somebody has compulsory convertible debentures and they were to mature into, they were to convert it into equity during this period, they were to get converted into shares during this particular period, then they are the only category which would be benefiting from this particular clause. But nobody can design their transactions that if their compulsory convertible debentures were to say get converted into shares after 3 years or 4 years from today, then they cannot prepone it, because in case your transaction is designed to take advantage of this 50% tax rate, you will not be given the advantage of this 50% tax rate. However, there is coming to this particular topic of debentures, there is no mention of the debentures, there is no change in the taxability of debentures. So any capital gain arising on sale of debentures, being convertible debentures, non-convertible debentures, optionally convertible debentures, will be taxable as per the rule of residence. That is, it will continue to be taxable in the country of the residence of the taxpayer, being Mauritius, and no tax will be levied on it on India. So this is again a kind of encouragement to debt investment structuring from Mauritius to India. Also, there is a grandfathering provision which says that for any capital gains arising on sale of shares which were acquired on or before 1st April 2017 would continue to be taxable as per the residence rule. That is, it will continue to be taxable in Mauritius and no taxes would be levied on it in the country of source, being India. So now, after appreciating the capital gain provisions, I think we can move on to the next provisions which are there. Article 27A, limitation of benefits clause. The first paragraph of the limitation of the benefit clause states that a company would not be entitled to the 50% tax exemption under the capital gains clause if the entire business activities were designed with the main purpose of taking advantage of this 50% tax advantage. The second paragraph states that the company should not be a shell and a conduit company. It should have real continuous business activities and it should have a bonafide business. So just to quantify or objectify this, they have given two conditions which are required to be satisfied by a company for this it to be clearly be a genuine company and not to be treated as a shell and a conduit company. For a Mauritian company to be treated as not being a company which is a shell or a conduit company and is entitled to the tax treaty benefits, it should be listed on a recognized stock exchange and it should have a total expenditure of at least Mauritian rupees 15 lakhs during immediately preceding 12 months before the date on which capital gain arises. Similarly, for an Indian company to be treated as a bona fide company with genuine business operations, real continuous operations, and not to be treated as a shell and conduit company, it should be listed on a recognized stock exchange and it should have incurred a total expenditure of at least Indian rupees 27 lakhs in the immediately preceding 12 months before the date on which capital gain arises. So now we move on to the another article, which is Article 22, Other Income. The Article 22, Other Income states that the first paragraph states that any item of the income which is not expressly dealt by any of the other provisions of the tax treaty, and the second paragraph states that it should not be an income which is effectively connected to any PE in the source country, then such a particular income would be taxable as per the residence rule. That is, it will be taxable in the country of the residence of the taxpayer and it will not be taxable in the source country. So now they have amended and inserted a paragraph 3 which states that notwithstanding anything written in any of the paragraphs of that article, any income which is not expressly dealt with any of the provisions of the tax treaty and is not effectively connected to a PE will be taxable as per the source rule, that it may be taxed in the country of source. That is, they have brought more and more income to be taxed in the as per the residence as per the source rule. So there is a shift from residence rule to the source rule. Now we move to Article 26, Exchange of Information. This is the only article which was retrospectively effective from July 2016. It has been vigorously reworded to add more and more administration, not just how the exchange of information should be effective between the countries. And Article 26A, Collection of Taxes, it broadly states that there could be cross collection of revenue claims of one government by the other government. if one government has specifically requested the other government to do so, and the other government will collect those revenue claims as per its existing local law mechanisms for collection of such taxes. I hope you enjoy the tax update, and please do let me know the feedback, and see you again. Thanks.